Welcome to TMS Insights, October 2019, an update from Jeremy Hook and Ben Clark on activities in the market. September has come and gone. October has seen a little bit of volatility come back into markets. We did see, Ben, an interest rate cut from the Reserve Bank, continuing that downward trend for long-term interest rates, and overall a pretty supportive environment for equities.
Definitely. I think the environment is primed for probably quite a good end to the year if we can get the big macro things resolved. And it looks like there's some progress in that regard. We've got a vote on Brexit this weekend, and Trump seems to be signalling a mini deal, and then the Chinese hadn't signed the deal, and then there wasn't a deal. But it feels like they're sort of getting a bit closer. But that's still the key sort of thing, I think, that's dragging on the market. But the US earnings season started off pretty well as well.
And we're going to do a separate video about the US stocks once that season's over, as we did last quarter. But that's the key things. And these are the things we know, and we've got enough from the low interest rate environment and the positive earnings environment to be confident about equities at the moment.
Yeah, I think so. I still think there's the rotation of capital that's coming out of fixed interest markets into equity markets really is potentially only just starting. And we know that, as analysts start to use lower discount rates, that also is positive for valuation momentum in the market. And, generally, things are looking pretty good. The outlook's looking pretty good.
And it's true, though, that not all boats rise with the tide. So, good stocks are going to do better than others. We're consciously aware of trying to improve portfolios and get better quality companies in them.
Yep.
But a number of our companies have done very well of late.
Yeah, I think if you look at some of the larger weightings, certainly there's several actually hitting all-time highs continually. And it still feels to me, Jeremy, like there's not that sense of euphoria in this market, which is why, and the Latitude float, I think is a signal of that people aren't falling over themselves to buy anything. It's still selective in terms of what's doing well. A lot of companies aren't doing well. We're still seeing some profit downgrades. We had 2 this week from some pretty decent household names. So, it's still a stock picker's market.
Yeah, just on that Latitude for a moment. So the window now, what happens at this time of year? Often you see a couple of floats. It's a typical time of year, October through to early December. It's that window where the corporate machinations can be working. Latitude was a financial services float that was attempted last year. It was attempted again through September and into October. We had a look at it, decided not to let our clients know about the stock, that we didn't think it was an investable proposition. They pitched it at a price target range between $2 and $2.25. and then repriced it lower to $1.78, and then canned it all together midweek. So good example of a case where the market wasn't going because it wasn't a positive set of industry dynamics, and the business wasn't really worth what they were trying to sell it for.
Yeah, they were trying to dress it up as something we sort of felt it might not actually be, I think, and I think that's the sort of feedback. And there is also sort of what we've heard since is a lot of international investors are extremely wary of the regulatory environment in Australia. We've got regulatory inquiries going on in all sorts of areas and consistently being launched. And the book that they were trying to put together, one area they said that really struggled was getting international investors to get enthusiastic about the stock and want to take it up. And this is institutional investors, of course. So I think there is, it's an issue we've got in this country at the moment, that there's a lot of oversight into a lot of different industries that are causing, the growth not to come at the rate that you might think it would. But I do think it's a good sign, sort of, you're always trying to take the pulse of the market, sort of, are we in that depression, euphoria sort of stage? We're not in that.
It's not absolute euphoria because they would have got away at a high-end price. So the market's reasoning all these things. There is, as you mentioned earlier, a lot of cash on the sidelines still. So when things go up, that's not euphoric for if you're loaded up with cash. So
no, exactly.
It's hard for institutions to get exposure. To talk about some of the individual names, Link has been one that we've been looking at lately quite well. It's obviously one that got, for the last year or two, concerns about its UK business with Brexit coming up, and we'll know next week some news on that with the parliamentary vote in the UK, which we think, again, this may have been overhyped as an issue for the markets, but Link's a high quality business with a real, maybe you can fill people in a bit about PEXA, Ben, because it's a fascinating business.
Yeah, so I think Link looks like a good quality, sort of slowly growing business. It's had an issue in the UK, had an issue in Australia last year with a regulatory change from the government, but both of those were sort of non-repeatable.
It's all about superannuation administration.
So, yeah, exactly, for industry super funds. But the business that they own within it is they own 45% of a company called PEXA, which we saw try and float last quarter of last year, and but the market was very different then, and they pulled the float. And Link, Morgan Stanley Infrastructure and CBA took out all of the remaining consortium equity owners, which were the state governments and the other banks largely. And PEXA's a business put together by Macquarie, which is been able to digitise property settlements. So what used to happen was we had a table here and solicitors and reps from the bank and cheques would all be passed around. That now happens on an electronic platform, which has led to lower costs for the consumer. It's made it cheaper,
faster, better,
more efficient. It's a deal where everyone wins. But you look at the numbers, and one of our long-held business is REA. This is an REA style business in some way, because there's 1.5 million dwellings that transact in Australia every year, and PEXA, in time, because part of the logic in the state governments getting equity is that they had to legislate that
the titles office changes over. So,
right, and so, or in New South Wales, all property transactions have to be digitally settled by 2021. So there's going to be this momentum onto the platform, and this could become, a WiseTech style. That these big tech companies, this will be a tech company, but it will be a very reliable sort of business. So it looks interesting.
That's good, And we mentioned in our last video about Thorney Technologies, which is a listed investment company, code is TEK, that we like the look of and think is a pretty investable one. So Ben, it's trading at 27.5 cents. It's the owner of a number of different various companies and investments, listed and unlisted. And its net asset backing is 25% above that. It's 36.5%.
Yeah.
So they're actually a good exposure, way to get exposure to a whole range of stocks at a discounted price.
Yeah, and a whole range. We know that there's this technology revolution happening. We know that it is just a part of investing in this area is that some of these businesses will ultimately fail and some will flourish, like their largest holding is Afterpay, and go on to big and better things. And this is a way, I think, that you can get exposure to those rising smaller technology businesses, but you take a portfolio approach. In one share, you'll probably own about 30 or 40 different companies. And rather than trying to monitor and manage them yourself, you're sort of outsourcing that and getting that spread, which you really do need.
And you met the manager, Alex Waislitz, who's a billionaire. He's done particularly well himself with his own investments. And again, his record is phenomenal.
Yeah, I mean, I met with him down in Melbourne about a month ago, and the thing I took out of the meeting, and I'm sure he wouldn't mind me saying this, is he sort of said his reputation is more important than anything, and his first goal was to get the share price up to the asset backing. He wants to see that happen, and we've seen him buying shares in this company pretty much every day.
Even
on
yesterday,
the market. And secondly, I think he gets access and looks at deals that many people will just never see. Because of his reputation. And he's got a team of guys there and girls who are looking at these deals, and he can put money into things very quickly. And it's not just the discount that we're interested in; it's also and the performance has been very strong.
Absolutely,
So
I mean, recently it's way outperformed the market this year. Way outperformed. So terrific.
It looks interesting.
Good one, Sam. We mentioned WiseTech earlier. I think it's really important to sort of highlight what's been going on. A terrific growth stock, absolute leader in every sense in the tech space. A great performer. But this week it came under pressure with a short selling report. So I think people hear this from time to time. It's worth explaining how these things work. People make money out of short selling, and they produce documents which actually explain a case, whether it's good or not, why a stock is overvalued. It happened to WiseTech this week. A company called J Capital released that. We saw the stock down 10% before it went into a trading halt yesterday. I mean, just to give a bit of colour, we really think WiseTech's a terrific business.
Yep.
Ran up a long way. But about this short selling as well, Ben, and these reports.
Yeah, I mean, we know that short selling is a massive feature of the market these days, particularly the computer-based trading. You know, they're buying and selling every day and often shorting stocks. So this is probably at the slightly more scurrilous end of the short selling, right, where a firm short sells a stock and then releases a paper at I would say, fairly opportunistic time, you know, sort of around lunchtime on a Thursday. It doesn't get released to the stock exchange. It gets emailed around to investors in the market, fund managers, etc. And it's designed to cause panic. And the motivation behind the person releasing this paper is to push the share price down so they can buy their shares back and profit. Now, we are seeing this. This is happening more and more frequently. A lot of these papers are released from sort of nondescript organisations offshore, which are impossible for ASIC to control or regulate. There's a really tricky. There's no real answers to how you stop this or how you do it in a more regulated environment, but it's happening. And
it's more for the investor to be aware of it and to understand it. It can create opportunities. It's a risk factor too, but it's certainly something that has happened in other stocks. It was WiseTech this week.
Yeah, I mean, we've seen Collection House have one earlier this year, Treasury Wine have one,
Corporate Travel,
and
sometimes they hit the mark. They really
and this is the thing, is sometimes they've actually seen issues in accounting which have turned out to be true, and there's been a lot that have turned out to be completely wrong.
Yeah.
And so WiseTech will come back to the market on Monday, present their side of it, and ultimately the market will decide who they believe is right.
Yeah, exactly. Yeah. Just before we wind up, just some good news from a couple of stocks that we keep an eye on. Challenger and also Fisher & Paykel Health. Yeah,
well, Fisher & Paykel's, a competitor to ResMed, and it's the number 3 player in sleep. They've had another profit upgrade on the back of their new mask release, and Challenger was one that we're probably feeling a bit better about because certainly what we saw, and they gave a quarterly update, was that the Japanese sales of annuities has taken off, which is good. The Australian annuity business is still under significant pressure as we see this movement of financial planners. But it looks to me like the business will probably come in the top end of that guidance range now, and
500 to 550.
500, it's pretty wide range. Yeah. But it also, I get the sense, I might be wrong, but I get the sense that this is the trough year of Challenger's earnings, and we might start to see an acceleration from here. So that was some good news on a stock that has been struggling recently.
Yeah, good. Excellent. Well, that's all we've got time for today. We'll be looking forward to bringing you more TMS insights in November.